Thank you everyone for joining us today. My name is Pete Seiler with Integrated Capital Management, a member of our business development team. Today, you are watching our fifth installment of Mic'd Up with ICM, and I have the distinct honor and privilege to be joined by Brent Leadbetter, partner at Research Affiliates. Brent, thank you so much for joining me today.
Pete, thank you very much for having me. It's an honor.
Truly appreciate it. So, for our viewers here, let's jump right in. Emerging markets tend to be somewhat commodity-centric economies, and given the supply and demand imbalances that have unfolded for a multitude of reasons, what do you see ahead for emerging markets?
Yeah, we're quite bullish, broadly speaking, on emerging markets, particularly relative to the U.S. And you alluded to part of it, their dependence or focus on commodities, and the fact that the commodities are popular today. But it goes beyond that. Given that we're very much a valuation-focused firm, mean reversion, or really the anticipation of mean reversion, is really driving everything that we do. So when it comes to looking at EM equities relative to U.S. equities, I'm just looking at the CAPE ratios through the end of August. The U.S. was right around 30. Broad emerging markets were around 14. So EM is quite literally less than half the price of the U.S. The U.S. That's narrowed a little bit from the peak. At the peak, the U.S. at the end of 2021, the U.S. nearly hit 40 on a PE ratio when EM was around 16. Even after the sell-off in the U.S., the spread remains incredibly wide. So if you can get stocks for quite literally half off or more than half off, that's an exposure that's going to be of interest to us given our contrarian nature.
Great, and that's tremendous information because recently we've been asked a lot about our relative overweight to EM because of the headlines that are out there about China, their slowing economy. However, your allocation has been relatively underweight to China. Can you talk a little bit about your macro view of that and beyond?
Of course. Yeah. First, I would note in terms of the questions related to the headlines, negative headlines in emerging markets, when you get an exposure that's half off relative to the US, almost by definition, the headlines are going to be less favorable for the cheaper exposure. There's a reason why something's half off, first and foremost. But the second part of your question, in terms of China specifically, and a lot of the concerns in China, when we're looking at exposures for equities, we're selecting and weighting companies by the sizes of their underlying business. What that translates to in terms of China exposures recently, as you noted, it's translated broadly speaking to an underweight to China, but specifically that underweight is coming from a few prominent industries and sectors within China, namely the technology companies that became so expensive during the lockdown period in the COVID-induced lockdown. Even as some of those firms have sold off, famously Alibaba peaked around $300 a share in 2020. Today it's around $80 a share. Essentially what that's done is it's taken Alibaba from an unprecedented level of expensiveness to just perhaps less egregiously expensive. So when we're picking companies by fundamental measures of size, by the size of their business, within emerging markets, some of these tech companies in China, even after their sell-off, still look more expensive than the average stock. There are, on the flip side, there are large firms you can find at extraordinarily low prices. Just to pick one as an example, Hyundai, you can buy for a PE ratio of in the neighborhood of 5, right? That's
Wow.
absurdly cheap. And Hyundai is far from the only example. There are a lot of pockets of very cheap companies within emerging markets. You don't have to buy the Chinese tech companies. Within China, we certainly have exposure across our strategies. That the exposure to China is somewhere in the neighborhood of 20% versus a 30 some odd percent exposure in the cap-weighted benchmarks. So it's simultaneously our single largest country exposure in absolute terms, while also being our single largest underweight in relative terms. So the Chinese economy is large. It gets a large representation in our portfolio as a result. What's happened is that even after the sell-off, the cap-weighted market, or just market participants in aggregate, remain overly bullish on China. In aggregate, market participants continue to pay a pretty steep growth premium for Chinese companies broadly. Specifically, some of those tech companies, Baidu, Alibaba, Tencent, Neti, some of these other tech companies, even after their sell-offs, remain richly priced, many of them.
Awesome. Again, great information. Appreciate the feedback. Pivoting just a little bit, what are you seeing from a global currency standpoint and the impact that it'll have on emerging markets?
Yeah, so in terms of currencies, I think I'll answer simply as a U.S. investor who's obviously a U.S. centric mindset. Whether it's the headlines regarding the euro reaching parity for the first time in 20 years, the pound at or near all-time lows versus the dollar. In short, again, given that we're contrarians, given we have a long-term time horizon, we expect mean reversion. We think that investors with the long-term time horizon should be favoring non-U.S. Currency exposure. So, effectively, if you ask me, what currencies do I like, I would essentially just say anything other than the dollar over the long term. I have no idea what's going to happen over the next 3, 6, 12 months. But if you have a long-term time horizon, an entry point for emerging markets exposure with emerging markets currency exposure looks really attractive today, just given how expensive the dollar is. I would love to have diversification away from the dollar in pockets of my portfolio where I have a long-term horizon.
Great. So as our time together here is drawing to a close, I want to take one last opportunity and kind of address something that everyone has talked about, heard about, obviously the BRICS. But what other economies or countries are you excited about? Are there any game changers out there that really get you guys fired up?
Sure. So the I don't know what our I guess we need a new acronym for the BRICS, maybe just the BICS now that Russia is no longer an option. But there are other large economies that are available to emerging markets investors. I think top of the list is going to be Korea. I already gave the example of Hyundai, but there are other industrials, commodity-based firms, steel, aluminum firms, metals in Korea that look attractive today. It's a large economy without perhaps the same level of geopolitical concerns that a U.S. investor would have with Chinese exposure today. Within the BRICS now. BICS, perhaps, a lot of Brazilian exposure continues to look inexpensive, even with the rally in oil prices, energy, some of the energy and commodities exposure in Brazil still looks attractive. Brazilian banks, the financials in Brazil are trading at much lower ratios than many of their counterparts in other portions of emerging markets. Outside of those countries, South Africa is another good place to look for commodities exposure. Essentially, when Russia was removed from the opportunity set, it took with it, of course, quite a bit of energy and metals and mining exposure with it. But it wasn't by no means was it the lone exposure to energy, metals, and mining within emerging markets or industrials for that matter. You can find other exposure. Pretty much nearly any exposure in emerging markets outside of the expensive Chinese tech companies, just a broad basket looks appealing, right? Because again, if EM as a whole is at literally half the CAPE ratio of the US, and you've got a pocket of Chinese tech companies that are pulling that CAPE ratio higher, if on the whole it's at 14, 15, that means you take those Chinese tech companies out. What's left is at a CAPE ratio that's closer to 10 or 12. So just broad EM exposure looks attractive. You don't have to there's no need to get overly cute and try to pick individual countries or individual industries, just broad exposure to EM also looks really appealing because again, it's really cheap. And one point that I'll note, a retort I often hear when we'll comment on the fact that emerging markets are trading at half the price of the U.S. One of the retorts I'll often hear is, well, of course they're half the price. I think they should be half the price. They're always going to be half the price. That's not actually true. You can go back just before the financial crisis in '08, when oil was north of $100 a barrel, when Goldman had their famous call for oil to hit 200 a barrel. At that point, many of the same energy companies that are so cheap today were actually quite expensive. In 2008, at the end of the year, actually, let's look here. At the beginning of the year 2008, so end of 2007, the U.S. was trading at a CAPE ratio of 26. The broad MSCI EM was trading at a CAPE ratio of 33. So it is far from a given that emerging markets will perpetually trade at half the price of the U.S. That's not the case. This is, while it's persisted for a while, this remains, we would argue, an exceptional opportunity to find equities literally half the price of our home country exposure.
That's really great. I know it's going to be valuable for the viewers of this episode. I can't thank you enough for taking time out of your busy schedule. We've enjoyed working with your firm. It's great to meet you here virtually, and I can't thank you enough for spending time with us today for Mic'd Up.
Thanks very much, Pete.
And again, everyone watching, it's been Brent Leadbetter from Research Affiliates, partner at Research Affiliates, joined us today for this episode. As always, if you do have any questions, we are here to help. info@icm-invest.com, and a member of our business development team will be happy to reach out. Thanks, and we look forward to putting together content for our next episode.